Now in this segment, we're going to look at what's happening with high frequency data and what is the implication and what are we seeing in the US in general now that we're starting to get some of these new GDP number or new inputs to the GDP number that we have to consider as what is good, what is bad, and what does this mean going forward. So when we look at just, in terms of activity in general, you can see that we've gotten some normalization out of Europe where we've kind of flatlined in general. When we look at Japan, Japan has made an announcement that they will not roll back limitations this week, and they're going to take it week by week as they look at ways to address COVID, the spread of COVID, trying to mitigate it. Obviously, the vaccine push continues. That's something that we're going to talk about in the EIA show in segment 2 in a bit more detail. And here you can see just in terms of where Europe is, everyone is pretty much migrating to this between 68 and 75% of normal. But the problem in that right now is we're seeing some of this essentially everyone getting stuck, and we're not seeing a real surge to the upside because we're seeing some really good data and then we get some offsetting data, and we're just sitting within this kind of friction point of which way are we going to turn over essentially the next 2 quarters. And that's going to be the biggest question as we go forward, and we keep trying to answer it, saying that there's a lot of excitement in the market, there's a lot of good things in the market, but we have to be really cognizant of wage compression, inflation, and what is that going to do to just the general activity of the populace. And that can be said in the emerging markets, as we'll talk about in later segments today, that we've seen inflation spike in a lot of different regions, right? Russia, India, parts of Latin America. They're starting to see some surprises to the upside, and that's causing some of these central banks to get a bit more hawkish about what is their opportunity to ease and continue to stimulate the economy, because there's going to be a bigger problem on inflation, especially as we see it actually starting to creep up in Europe as well. So here you can see China has fallen off hard. We're going to talk about that in the OPEC show in a bit more detail, because we're going to look at OPEC, given the fact that, shockingly for those that follow me on Twitter, Saudi Arabia has started to say that they're going to increase production, or at least the advisors are stating that they're going to increase the production of the voluntary cut. We already expected that, because when we looked at month over month exports were up 500,000 barrels a day. We talked about that on Friday when we were looking at what was happening in terms of the export market, because production and exports are 2 different things, and we have to look at them and understand what is going to happen next. So China is going to continue to slow as Lunar New Year progresses, and lunar activity has been a bit slow, which is again something that we're going to talk about in the last segment. And this is just aggregating it all together so you can kind of see where we sit on a global level. We've flatlined. Obviously, the move lower in China has pushed us down. The bigger issue, which we keep coming back to, is trying to get to the pre-holiday high, and we've been struggling to get there. Emerging markets have finally started to approach that pre-holiday level, and it's really been driven by India, which we're going to talk about in the last segment, because India has been a bright spot and should continue to have some of these benefits, where we're going to see some of this pressure in general as emerging markets are going to start to see that inflation fear. They're going to have to get a little bit more hawkish, slow down some of that stimulus, and advanced economies continue to kind of be in this weird, holding pattern that we're really not able to break to the upside. And when we just look at fiscal stimulus, U.S. is now leading in fiscal aid as a percent of GDP with new measures. U.S. government will redistribute a quarter of GDP in a span of 2 years, which, if you look at it, essentially pales in comparison to what happened during the great financial crisis or the financial recession. So I think here you can kind of get an idea of what is actually happening in general on what was done during 2008, 2010, and what is being done from 2019 through 2021. And you can just see that everything really pales in comparison in terms of North America, parts of Asia, obviously Japan with their new stimulus. Europe continues, but also Latin America with Brazil, which is why Brazil is something that we're watching on the inflation side. And obviously China continues to do more, which is something that we're going to talk about again in the last segment. But the issue comes into if I keep printing so blindly, well, obviously it's going to start to roll into and show up in some of these numbers. And as when we were filming the pregame show with David, Rams, and Wood, we had some data come through about the bid to cover ratio. So there's two sides to what's happening right now. It's obviously what are people willing to buy these bonds at what interest rate. So when you have rates starting to creep up because the bid to cover ratio is coming down, so you have to incentivize guys to essentially bid to incentivize people to show up at these auctions. So let's take two ones that came out recently. So the 3-month bill, which drew 0.04% interest, they sold $54 billion in 3-month bills at its weekly auction. But the bid to cover was 2.72 versus 6 previous auctions average at 2.95. So when all that means is you're getting less and less activity in these auctions, and when we looked at the 30-year, you were at 2.17, again showing less activity and unwillingness to purchase at these levels unless the interest rate is going up, which is where when we look at the yield shifts, we continue to see this move higher with the 30-year now over 2%. We're going to have the 20-year auction today. It's not out yet. And you're seeing this move higher as the demand continues to move up in general, as we're seeing more and more activity. Now, when we look at gasoline in general, we have to look at, okay, well, what is happening in the U.S. in activity levels? And lockdown indexes have started to come down, as we were talking about, with more mobility coming in through California. We're seeing some of those benefits. New cases have continued to fall. Unfortunately, new deaths continue to remain elevated. But again, it's cases, hospitalization, deaths in that order. Cases fall first, then hospitalizations, then deaths. So we're still seeing that where that case decline will start to show up in the death count. We can, the decline in the death count, which is also being supported by more vaccines. Whether it's first dose, second dose, it's starting to roll out and getting people more comfortable in terms of moving around, which will help that lockdown index get a little bit better. We need to see that show up in the jobless claims because that's where we continue to see the biggest headwinds as we go forward. Now, just looking at some of the things that have come out in general, retail gasoline demand dropped 14% on Monday, obviously due to weather issues. And these are things that we're going to talk about in more detail in the EIA show, because we're going to have to weigh what happened with loss of production, loss of refining, and then people just unable to move due to either loss of power and or terrible weather conditions. Because let's be fair, plowing in Austin, Texas is going to have a different level of equipment than plowing in Syracuse, New York, and especially people that know how to do it and or drive in it. So again, stay safe, stay home as long as you have power. If you don't, hopefully other family members do. But when we look at things that are happening in the U.S., we have to consider the stimulus that has come through, because as we showed in the previous chart, what is that stimulus in general? So when we look at the Democratic control of Congress, the way for $750 billion of extra pandemic aid, we have to kind of give this breakdown of the $300 billion in stimulus checks, $150 billion in unemployment insurance, as that started to feed through the system, which we'll talk about in the next segment, and then the benefits to support and local governments. And when we look at comparing the stimulus checks in general, we have to look at what is the Democratic stimulus, what was expected, what is coming through. And here you can see just the head of household to independence. Obviously, there's going to be a increase in just stimulus coming into different families. As we know, what is coming for children, what is being issued to the different individuals to just stimulate growth. Now, the problem is, what we're seeing, we did get an increase in retail sales, which we're going to talk about, but that was the initial push, and now some of that is starting to come down and starting to normalize as we go through the remainder of Q1. But this stimulus will help restore savings that the lower income levels were forced to use, because we have seen the bifurcation of who's getting it, but also how is that money being spent and where is it being spent. So then when we look at the federal outlay on just the general, so all 5 categories together, the average person is going to get about that $1,900. COVID-19 containment and vaccination aid to state and local federal spending, that 1.9 trillion, 750 billion into those areas. Direct aid to families, that's 600 billion between childcare, tax credits, and other. Aid to financial vulnerable households, 400 billion, and aid to businesses through SBA loans, PPP loans, 150 billion. But when we think of the third stimulus check, what is it going to be used for? And this is when we keep talking about savings, because even though we have shown net an increase in savings in the U.S., it is not equally distributed. The top 2 quartiles of a 5 quartile income backdrop, those 2 top quartiles have seen an increase in savings, while the lower 3 has seen a drawdown of savings. So where is this money going to go? Well, here's your answer. And this is obviously looking at the most recent survey. 34% said savings, 30% said food, 22% said housing, 18% said debt. So just in general, over close to 70, most of it, let's just say about almost 80% of it is going to just maintaining the debt that you took through credit or the money you pulled from savings to try to make yourself whole. So again, you're just keeping people afloat as we try to get to the other side and to a normalized economy with everybody feeling better about their situation. Now, when we look at the projections of real GDP based on the Biden package going forward, here you can see kind of that push up on the real GDP in trillions. This is no additional support. And this is where we come back to the benefit of fiscal stimulus versus not fiscal stimulus, because should we be protecting companies and or people who are acting outside of their self-interest in the sense of just spending blindly, versus what is kind of a due course of adjustments, as we've really have never really allowed price discovery in the market. And this is where we come back and forth with how quickly can we get to this pre-pandemic essentially estimates from Jan of 2020 on that GDP growth. And obviously with that fiscal stimulus, the hope is that we get there faster, and then we would pull up the economy. So even though we're issuing debt, or we're going to issue debt to essentially make these payments, that it'll offset itself with GDP growth. And that's kind of what this is trying to pick up. The problem is GDP growth has been fleeting, and we continue to borrow, and our deficit continues to grow. So as we looked at the bid to cover, the demand for interest rates going up, interest rates going up, that means our interest expense is going to go higher. The Fed's going to have to step in. If the Fed steps in and starts buying more T-bills, well, we already have an issue in terms of volume available. What are they going to do with yield control rates, in terms of trying to adjust the back end of the curve as the 30-year continues to push higher? We're seeing a lot of this friction in the market, and there's no easy solution because central banks have painted themselves into a corner. And not only governments, but also corporations and people have been drunk on free debt. And this is just looking at those capital flows. And when we look at foreign direct investment, you can see that there was that big drop as we went through 2020. And even though there was a drop, China got a bigger piece of that bucket. But the problem is that is starting to go away as people are looking to diversify supply chains. We remain concerned about what is going to be invested in China. This will reverse. It's just going to be a matter of where does that reverse into. And the areas that we think are going to see the most increases is not only just in the US, but also in Southeast Asia. But when we look at this activity, this movement through the system, we have to be cognizant of what is some of the inflation impacts. And lumber prices are no different. I mean, we can see just how aggressive this lumber futures prices is getting, and that's $1,000 per 1,000 board foot. You can just see that the lumber futures continue to go limit up. We've had cotton do that just because people are moving away from cotton acreage into food acreage. Again, as we've been talking about with food shortages, that's causing issues on the cotton market. The problems are just persistent in general, and that's why we keep talking about inflation on a CPI level, PPI level. Where are these prices paid, prices received? And that becomes a bigger problem. but housing units authorized by building permits. So you can see those building permits are continuing to increase, which is going to keep a bid beneath those lumber prices. But as rates continue to go up, and if you think about the 30-year pulling up some of the mortgage rates, how much of this price increase can be passed through to the consumer as that mortgage gets more expensive, and the ability of passing through some of these costs. So maybe those margins get shaved. Instead of building a 2,500 square foot house, you build a 2,000 square foot house. These are things that happen because the permits are issued. You can build on that lot. You might have to maybe send in new blueprints that shrinks the footprint of the house, limiting the amount of lumber that's going to be consumed, bringing the total cost down. Again, trying to adjust for what does this look like going forward. And then when we look at some of the manufacturing data, which came out today, we had a nice surprise to the upside. And we'll talk about this in more detail, but the general business conditions versus current, you can see that things had a little bit of a bounce, which is positive. The expected has gotten better, and that comes through as we get more stimulus, as we're starting to see some of these things respond. But what has that done? That's pulled the dollar higher. That's pulled interest rates up because, again, the view is maybe we don't need as much stimulus, and we're starting to get some of this normalcy, and we're starting to see this movement of capital, which is generating that inflation that we've talked about. And the U.S. industrial activity falls while far below peak. So when we look at manufacturing, you're starting to see that move up. Capitalization is starting to approach where we were pre-COVID. You're still not back to it, but when we look at PMI, when we look at some of these leading indicators, the trend is heading up. The problem is we haven't seen this just yet reflect in employment, and that's where we're starting to get concerned because we really need to see that employment pick up as well. And then that wraps us into kind of what has happened with this weekly economic indicator. And when we look at this weekly economic basis, you can see that the economic side on that came out last week, which should get revised up as the Atlanta GDP expectation got pulled up by almost 3 percentage points. Here you can see that the Fed, the New York Fed, is down to about negative 2.6%. As now we're starting to get that reversal in industrial, that will push up. But when we think about what is happening overall, we have to consider that the employment remains weaker, which has been that overhang on the consumer side. And now that we talked about that, we have to kind of roll it into, well, what is happening at the retail sales side, and what does that mean for some of these inputs when we look at that economic index in general?